Hello, this is Popeye. I want to record a new video on how to trade deviation. Deviation can appear in many different ways. So today in this video I will mainly focus on the what I call the standard range deviation. We will see how to select properly the range to focus on the important level where the deviation can happen, how the deviation can be triggered, and how to execute the trade once we see a reliable deviation happening. But before moving to the chart, make sure you subscribe to the channel, leave a comment and a like. And without further ado, let's start to see what is a deviation and how to trade it. So first of all, deviation are patterns that appears in ranges or support and resistance level. So the first important part is to be able to properly select a range. There are many different ways to select a range, but once the range is developing, the first way to define the range before its full development, or the standard, let's say, way to map the range, is to use the first swing high and the first swing low. So if the price is moving in an uptrend and then it starts to range, we want to select potentially the first swing high and the first swing low and the first swing high. So in this case, we see that the price was uptrending, then it started potentially to range, so we map our range selecting the first swing high where the price stopped to uptrend, let's say, and the first swing low that determined the evolution of the range. So this is a range that started to form. We are not yet sure how well defined it will be, so we select the first swing high and the first swing low. The second part of interest to see if our range is reliable is mid-range. So the 0.5 Fibonacci, or if you use a normal range tools on TradingView or other trading platform, is the mid part, the exact center level of the swing high and the swing low. What you want to see at mid-range? You want to see that this mid-range is somehow kind of respected. So you want to see some interaction at this level, and you want to see this level to provide some sort of support and resistance, at least temporary. So you want to see that this level is somehow a respected level. So it should not be 100% precise, but you want to see the mid-range to be at least partially relevant. So once the price starts to range inside your boundaries, you know, as in all the ranges, that you are interested on longing support, so longing the lower band of the range, and you are interested to short resistance. There are many techniques to long and short resistance in a range. Long support and short resistance in a range. One of these techniques is the deviation trading strategy. So what is a deviation? Basically, it's a move outside of your defined range. This move is faded, so price go back inside the range, and you know that in case your deviation is triggered, you can try to trade to the opposite part of the range. So range can be broken, so we might have a break of the range to the upside or to the downside. But in case the breakout is a trap, is a fake out, a bullish trap or a bearish trap, instead of the breakout, price go back and start to trade inside the range. We call this fake out, this temporary price action outside of the range of deviation once the price go back and find acceptance back in the range. In that case, you can start to develop a strategy to aim at the opposite side of the range. So whatever is a bull trap on the top of the range or a bear trap in the bottom of the range, that in this case is a bull trap, you know that if price find acceptance back above in the range, then you can target the other end of the range. Why this strategy can be effective if properly used? Because usually they involve the liquidity hunt or the stop loss hunt. Why? Because mainly in a range, people will try to long resistance and short support, and they will hide their stop loss just outside of the range. So perhaps longs were trading in this way, shorts were trading in this way, and as long as the price range inside here, people will all put stop losses for their longs and for their shorts just above the range boundaries, and whenever a deviation occurs, so they shorted here aiming the price to go down, then we get a deviation, their stop loss get hunted, and the price then find acceptance back below. So since all the liquidity at around range high or range low has been hunted with this move, then we can have a powerful move on the other direction. Again, because liquidity was hunted, stop loss were taken out, so price is moving in the other direction. Remember that once we take out the stop loss, we also take out the take profit of the existing position that were developed in this range. So we hunt for liquidity, taking out their stop loss, but we also remove potential resistance level, taking out their taking profit. That's why once the liquidity is hunted, then it's easy for the price to move in the other direction. Once again, we took liquidity, taking out their stop loss, we remove potential resistance level because their take profit was actually a resistance level, and then the price can move more freely to the other direction. Same goes for the other side of the range. So longs were putting their stop loss here. If the price start to trade back above, perhaps they didn't take profit, their stop loss is hunted, price go back and move to the other direction freely because we took liquidity on their stop loss, so we remove their position and we took their liquidity. Also, we remove a potential resistance because we also take out their take profit level. As I said at the beginning, there are several ways of playing deviation. Today I want to show you the standard range deviation. This is not a setup that I invented. The trader that is using the most, where I learned from, is called Rect Proof, a very good range trader, and he has a lot of documentation in his profile about this setup. So basically, the standard range setup evolves more or less like this. So we do have whatever is uptrend, downtrend, but we have the formation of a range. So let's say that in our case, this is the formation of our range low, range high, and we do have some interaction at mid-range, price start to move down. We do have our deviation, so we took out range low. And then what we want to see here, it's a market structure break. Once there is a market structure break, we try to enter in a possible demand area and we target the other level. So let me show, then we will see in the chart better, but it would look something like this. So we have let's say four important things that has to happen. So range form, range high form, range low form. We would like to see some interaction at mid-range. Range low or the opposite for the short range high, but now we see for the long scenario get deviated. After the deviation, price find acceptance back inside the range. We do get a market structure break. So in this case, a bullish market structure break when this series of lower highs is broken here, and we try to enter in a potential demand zone, looking for a trade to the other side. Our trade setup would look something like this. So we try to enter in demand, we hide our stop loss below the swing low or the deviation, and we target the other side of the range. I personally, in this sort of range setup, always take some profit at mid-range, because we say that mid-range is an important level, so we are not sure that our trade will go to final take profit, so I always like to take a partial profit here. This would be the long scenario. The short scenario would be, let's say, something similar, but just inverted. So we do have, again, some sort of price action that bring us to the formation of our range. Mid-range start to be at least partially respected. We do have a deviation above. Sorry, just to make it more. So we do have some sort of price action. Our range start to be formed. We do have some initial respect of mid-range. Price start to move higher. We do get a deviation. We do get a bearish market structure break. We try to enter in supply, and we aim at the other side of the range. So in this case, our short would look something like this. And the explanation is always the same. So we do have the creation of a range low, range high. Somehow mid-range is respected to give us a little bit more confidence. We do get a deviation outside of the range. Price failed to stay above the range and find acceptance back below. We do have a bearish market structure break with a fresh lower low. We try to enter in some sort of supply, and we target initially mid-range and finally the other side of the range. Another trick that you can use in this kind of setup is that you can always leave your 20-30% of your position in case the range is finally broken and price go to the other direction. So you get a deviation, and then we move down to the other side of the range. Let's try to see some deviation that happen, for example, in the Bitcoin chart. This is, let's say, one of the recent price action. So as we said, we do have the formation of a range low, range high. Mid-range looks like fairly respected. As you can see, there is some interaction, and the level is showing relevance. We do have a deviation below, in this case in the form of a swing failure pattern. We do have a market structure break. There is a dip, then we will see, and then price at least has moved so far to mid-range. In this case, the setup would have looked something like this. So we do have the market structure break here. So as you can see, there is the deviation, and then there is the market structure break. This was potentially the demand area that formed, that was created before the market structure break. So it's the last red candle before the bullish market structure break. That area was tapped and there was move up. So potentially you have entered here somewhere in this demand. You have hide your stop loss below the deviation, and you aimed first at mid-range and then at range high. Let's look for some other deviation. So this was the long range Bitcoin was trading back in December. We did have some sweep here, and was a kind of a fake, because but you could also say, let's say for educational purpose, we did have here a small market structure break. We did have here a tap into this demand, and the price then moved to mid-range. Then once again we came down. We did have much clearer deviation here below. We did have the market structure break. We were waiting for the price to visit this demand down here. We did have a visit to demand, and then again a visit to mid-range with this dip. We never went up above. That's why to take profit and move stop loss at break even after the tap at mid-range is always a good strategy, because not all the standard range deviation go to the other side of the range. You can see we did have a small deviation. So here at the beginning our range was supposed to be like this. First swing high and swing low. We did have this deviation here. So the price we created range high, range low. Mid-range, as you can see, is fairly respected. We move up. We went back inside the range. This is our supply level that was not really tested here, and probably not here. So here we never had our entry, but you can see the deviation. Then in this case the strategy would be different, not exactly a standard range deviation, because it was never really filled. Let's see if we can find some more. This is a little range we had in Bitcoin back in August. This I'm just using the high time frame, but then you can find many of these. Range low is formed, range high is formed, mid-range is sort of respected all around here. We did get a deviation, price go to the other side of the trade, but it never gives an entry. So we never get the standard deviation setup. You could have traded in another way, but not in the standard. Here we do get another deviation below the range. In this case, we have some sort of retest of this probably demand level down here, not really, and price move to the other side, and actually finally break the range. So not always you get your perfect entry on the demand. Probably we do have something similar here in this zone here, where again range low is formed, range high is formed. Also here you can see that mid-range is sort of respected. You see support, sort of resistance, support to the move up. Again here we did get our deviation here, and probably this is in a higher time frame a potential. Yes, it is the one in the 12 hours. Then you have to play a little bit to find the right demand zone. This was the 12-hour demand, because here there is also a 12-hour market structure break. That is a little bit what could create confusion. We did have a 12-hour, that is the time frame I'm using now, market structure break. So the demand we can use is the 12 hours. We get a tap in the 12 hours demand. We go to mid-range and also to range high. So let's say a trick or an advanced concept that perhaps I'm usually marking the range or the 4 hour, because it's a time frame that I use. But if you see that the market structure break is not just in the 4 hour, but perhaps is in a higher time frame, then you can use the demand of that time frame. So in the case of the 4 hour, the last red candle before the market structure was this, just to show. this was the 4-hour demand, but in this case, as we have seen, the break instruction is also on the 12 hours because we violated also the last lower high, higher low of the 12 hours. So in this case, we do also have a valid demand on the 12 hour that is pretty wider and gives you more room to plan your entry point. So in order to, let me see if I see some other example. Probably here was again another deviation. The problem that the longer the range develop, the less reliable our first selection of the range is valid. So in this case, you can start to use volume profile or other tools. As I said at the beginning, there are many ways to select a range low and range high. I like to use the one that I explained today, especially when the range is a fresh range, so is a newly born range that is still developing. So in that case, using the first swing high and the first swing low helps you to have at least some preliminary boundary before the range start to develop. As you can see here at the beginning, swing high, swing low gave a little bit of edge because we did get this nice deviation and this nice deviation. Then the range start to develop and is becoming wider because it's deviated further. So in this case, the range then started to range for a long time. Here in this case, you would have a little bit to adapt your range high and range low according to this development. But let's say it's a little bit of a advanced concept. I like, for example, in this current Bitcoin price action, this range, because still this range low and range high are well respected so far. Especially range high has never been deviated, the range low has been deviated, and as you can see, we traded back inside. So just to recap, I wanted to keep this video, let's say, as the first video on deviation, then we can discuss further. So deviation are powerful strategy to trade ranges because once they occur and if they are properly identified, they can give you an edge to trade to the opposite side of the range. The first part that you have to understand is how to select properly a range, and we said that once the range start to develop, we use the first swing high and the swing low and the first swing high. Then we will see that once the range develops, we can use other technique. Once you have selected your range, the second tip or trick or things that we have to keep in mind is that mid-range need to be somehow respected. So wherever price is moving to mid-range, you want to see it a little bit giving relevance to the price action. Once you have these three factor developing, now we are waiting for finally the deviation. The deviation, what is? Price goes below range low or above range high, trade there for a certain amount of time and goes back to the range. So now we are potentially able to call this price action a potential deviation because we deviated outside of the range and now we are trading back inside. What is the last trigger or factor we want to see before taking the setup is we want to see a market structure break. So if the price was trading like this, we go down, we trade here for a while, we need to see a market structure break. So we violate in the case of the range below range low, we want to violate the bearish trend or the bearish structure, and then we are ready to enter in the demand that is created before the market structure break. So remember that here you can trick a little bit and you can play with the demand according to the kind of market structure that you see after the deviation. So we do have a deviation according to the time frame that we are able to break. Then you can look for a following demand. If we break the 1 hour structure, you can look for the 1 hour demand. So the last red candle in the 1 hour time frame before the market structure break, same for our 12 hours. So if we break the 12 hour market structure break, let's say that was this one, then you can go in the 12 hour time frame and select the last red candle before the market structure break. In this case, a 12 hour candle. We place our order around the demand, then perhaps in another video we can see how we can further define that entry, and we hide our stop loss just below the deviation level, and then we target first range, mid-range, second range high, and potentially we leave some for breaking out. My strategies would be to take something around 30% at mid-range, so 30% around mid-range and move stop loss at break-even, take another 45% at range high, and if you have confidence that the range continue, you keep something as a moon bag, and then potentially the range will break and you will have a much better returns. Exactly the same strategy will apply for the range high. So in case we do get a deviation, price move like this, we get a deviation above the range, we go down, we bearish market structure break. So we did have the deviation above range high, we did have the bearish market structure break, we try to enter somewhere in supply, we hide our stop loss above the last high and above the deviation, we target mid-range and range low. So I think it's everything. Remember the few concepts, how the range is formed, so swing low, swing high. Remember the relevance of mid-range. Remember what you want to see in the deviation. Price should find acceptance back inside the range and should give you a market structure break. You enter in demand or supply if you're short. You hide your stop loss below the deviation. You don't want to see the price to deviate back below again. You target mid-range, range high, and potentially a breakout of the range. So I really hope you find the video useful. This, as I said, is the first lesson on this topic. We can do some advanced then concept in the future. But before leaving, make sure you subscribe to the channel, leave a comment and a like, and stay safe out there. Enjoy. Take care.